Hi, this is Stock Investor Davis. Let's take a look at Netflix reviewing its 2023 quarter 3 results, also looking ahead at its fourth quarter guidance and 2024 projections, and closing with a technical analysis of the stock price. Please like and subscribe. Starting with its income statement, we highlighted the larger changes year over year for the quarter and for the 9 months ended. Its revenue is up over $1 billion for the 9-month ended, from $23.8 billion to $24.9 billion. This is countered by an increase in its cost of revenues of roughly $700 million and its general and administrative costs of roughly $100 million, resulting in its operating income to $5.4 billion from $5.1 billion. These results were gained from a healthy third quarter with $8.5 billion in revenue and $1.9 billion in operating income. Overall, its net income for the quarter was $1.7 billion and $4.5 billion in the 9-month ended. The big pullback from this statement is its other income dropping from $677 million in the prior year to $124 million, and this is due to the foreign exchange rate fluctuations. Next, we have a breakout of its revenue and memberships by geography. This piece adds to the positive sentiment for the company. In all 4 regions, we see over 1 million new memberships during the quarter. Its second largest region, Europe, Middle East, and Africa, adding nearly 4 million members this quarter. In the 9 months ended 2023, we see over 16 million new members compared to less than 2 million new members in the 9 months ended 2022. In addition, of the 16 million new members added in 2023, 8.5 million more new members were added this quarter alone. It's planned to eliminate plan sharing while adding the ad-based tier appears to be working. One final item relating to its income statement, we see its operating margin increase from 19% to 22% this quarter when comparing the quarter to the prior year's quarter. Pivoting to its balance sheet, we see minimal fluctuations worth noting. The bigger changes being a $2 billion addition to its cash balance, short-term debt balance going up $400 million, treasury stock going up roughly $3.5 billion, and retained earnings going up more than $4 billion. It's likely that the increase in cash is due to reduced spending on content assets, possibly relating to the writer's strike. The short-term debt is being pulled from long-term debt, so it balances out. The treasury stock increase relates to the company stock repurchases, and the retained earnings increase is from net income. Also, its current ratio is above 1, which is generally a good indicator. Switching to its cash flow statement, many large fluctuations of note here. Some we touched on previously. Within its operating activities, there is less spending toward its content assets by nearly $4 billion this year and about $1.8 billion this quarter. Smaller changes in this section include more money spent towards content liabilities, other current assets, and other non-current assets and liabilities, totaling less than $1 billion, essentially the normal course of business. On the flip side, less money spent relating to its foreign currency remeasurement on debt and accounts payable, also totaling less than $1 billion, effectively canceling each other out. Within the investing section, we see $500 million spent on short-term investments and a $900 million gain from proceeds of short-term investments. Wrapping up with its financing activities, the big change here is $3.5 billion spent on stock repurchases, $2.5 billion of that in this quarter alone. One note relating to the recent added spending towards its stock repurchases: the board of directors has approved authorization to repurchase $10 billion more in stocks with no expiration. It's a pretty fair assumption we'll continue seeing more repurchases over the next quarter, especially considering the large amount of cash on hand. Closing out the financial statement report, we can look at management's guidance to close out 2023 and into 2024. It's now expecting its full year operating margin to hit 20% and its free cash flow of $6.5 billion, up from $5 billion. Then in the bottom left, we see its fourth quarter forecast with revenue growth of nearly 11% at $8.7 billion, the largest growth in over a year, but a big pullback in its operating margin for the quarter at 13% compared to its full year at 20%, and net income pulling back below $1 billion. It appears that the fourth quarter at Netflix is a low performer, maybe due to holidays or year-end bonuses. Of course, we'll see how it plays out. Regardless, it's shaping up to be a solid quarter compared to prior year's fourth quarter. Finally, it mentions operating margins of between 22 and 23% during fiscal year 2024, which is huge as Netflix continues to add new members. Moving to the analysts, as of 10/28, they are projecting $8.2 billion in revenue, which is lower than management's $8.7 billion. This extends to the full year analyst revenue projections. Then the earnings per share is $2.07 when management forecasts $2.15. Again, this extends to the full year. We'll see how this fluctuates throughout this final period. Wrapping up with the technical analysis, Netflix currently trading at $397. It's currently surging back towards its uptrend starting in July 2022 after dipping below the range, the bottom of the range being $411, support cited at $330, and light resistance at $416. The price is okay. Thank you for watching. Please like and subscribe.